Okay, welcome everyone. Good morning. We'll start our lesson 2. Today lesson will go through LO2, learning outcome 2. As you couple of you know me, my name Anjum and my email address anjum@ukversity.co.uk. If you have any question, please you can drop me email. Today's session will go through LO2, which is about understand the appropriateness of financial reporting framework, which will go through the financial statement and how we can use the financial reporting framework. So as we discussed in the previous lesson 1, this unit will ensure the student able to examine the corporate reporting, number of perspective, which will go through prepare the how we can prepare the corporate reports like a financial statement of comprehensive income, statement of financial position, statement of cash flow, statement of chain inequity. So according to IES 1, International Accounting Standard 1. We have International Accounting Standard Board who set the standards, conceptual framework used to frame work as the basis of the judgment in applying international reporting standards, different IFRS, International Financial Reporting Standards. Okay. So like we have a new standard IFRS 16, which is about, the leases, and these, should be treated into our financial statement and should be reflected. So that will be our discussion in our lessons. Please always good to be, you check, what your current knowledge at the moment, scale 1 to 10. Let's please guys spend 2 minutes, just reflect, what you know about financial statement. Scale 1 to 10, and we prepare 4 types of financial statements according to IAS 1, International Accounting Standard 1. Statement of comprehensive income, which is also known as profit and loss. Statement of financial position, which is also known as balance sheet. Statement of cash flow, which shows inflows and outflows of the cash, and statement of chain inequity, which is shows how much dividend we paid, how much shares we issued, how much return earning we have during the year. Under IS 1, always financial statement we need to be should reflect true and fair information. What true and fair information should reflect? IES 1, International Accounting Standard 1, report inventory, raw material, finished goods, work in progress. That's our IES 2, how we can record the inventory in the book of accounts. So that will be in our discussion as well, which we'll go through. Any question from anyone? Okay, guys. So today lesson is indicative content. What we're supposed to learn really is financial performance of different entities, revenue, non-current asset, leases. These are the keywords those will use, we'll cover in our lesson, period, end of period adjustments, and how we can do the inventories and different depreciation methods we'll discuss. That's all will be the key in our discussion. Okay. So please, when we do and follow the framework, or we follow any professional code of ethics, as a professional accountant, we need to be make sure the financial statement should be prepared in line with the accounting standards. So what standard we said we are following, because nowadays businesses throughout the world, we are following IAS 1, International Accounting Standard 1. So PPCIO, what is a PPCIO? Popular People Chat in Offices. So it's good to know, the professional code of ethics. If you're a member of ACCA, member of any other awarding body, if we should follow these professional code of ethics. So professional behaviors is first. To remember easily, Popular People Chat in Office. First P is the professional behavior. Second is the professional competencies and due care. do care, which is mean up-to-date knowledge, like you do CPDs every year and keep the record. Confidentiality, keep the data confidential, don't declare to third party without the permission of the client. Integrity is mean honesty, and O is objectivity. Objectivity mean unbiased information, not conflicting information. Okay. Then we've been given IS1 2.1. We have assess application of financial reporting framework. So when we looking a limited company give owner a limited liability, the owner liability is the limited because in term of D2, we can look around how in different companies and framework, which we'll go through in a minute. So we need to be first, what is meant by limited liability. Limited liability is like, the company registered in the company house. We follow the Company Act 2006 in the UK, and the company have a separate legal entity. They have a limited liability. So if you want to claim, but it's a lot of people think is a limited liability doesn't matter. You do fraud and things and close the company, it's still limited. But these limited liability can be unveiled and it can goes in the court. Yeah. So we need to be we need to be look around. So that's which we need to be. So limited may be owned, and managed by different people. Limited companies are owned by the shareholders. Shareholder appoint directors to manage the business, and there may be a large number of shareholders, and shareholder receive the share of the profit in shape of the dividend. So that's the key, which we need to be. Okay, so when we prepare the financial statement, we said earlier 4 types of the financial statement. So limited company, the statement profit and loss. So what shows, under IS1, we really follow the layout, So first we include the revenue. Revenue, also known as turnover, sales revenue, is the same. Then cost of sales, how much cost you to buy those goods are manufacturing if you're doing yourself. Then minus it's your cost of sale, you will get the gross profit. That's not a net profit. You have other expenses, those are indirect. We minus them, and then we'll get the profit before tax, profit after tax, and this will be the profit from continuous operations. So that's sometimes your operation discontinues one unit of the business, you want to sell it, that's and you earn that profit, and that profit will be discontinued operation. Profit can be happen in a loss. Okay, so statement of financial position, which is also known as the balance sheet. It shows asset, it shows equity, it shows liability, which will go through the following. Okay, this is IFRS, International Financial Reporting Standard Pro Forma. That should be okay. Always good to be prepare your financial statement 2 years, because one of the quality of the financial statement we discussed in the previous lesson is need to be comparative figures, 2 years figures. So revenue, cost of sale, gross profit, distribution cost, can be administrative cost, different expenses we can chart to these heading under IS1. We're not making many heading, we're reducing them, and we adding all the expenses, and we'll give the notes, and in the notes that people can read it. And profit from operation, finance cost, which is mean interest if you borrow money, and then profit before tax, and then tax. So that's which we'll carry on doing. Okay, then we have revenue, cost of sales, gross profit, a distribution cost, finance cost, and profit for the year. So that's that's the way, and we can compare 2 years what's happened. So that's always good practice. Okay, then statement of financial position, which we will prepare in account. So that's which we need to look around. Okay, so we have a non-current asset, the asset which we can use it many years, that's a non-current asset. Then we have intangible. Intangible is a goodwill, like patents, copyrights. So that will be called intangible asset, property, plant, equipment. So we can put the heading under IS1. So all non-current assets come first, then current asset, the asset which we carry on churning are their values within a year's time. So inventories is means stock, trade, and other receivables, and prepaids, everything we put under this heading, and the cash and cash equivalents can be uh, so cash itself are the prepaid, so we carry on adding these, and that's our, and we compare. Then we have, if you add current and non-current asset, that's become your total asset. Total asset should be, that's my debit side of the account. Okay. Then we have equity and liabilities. Equity, we have share capital, share premium, return earning, revaluation, surplus. So that will be my equity. Equity means the shares. So that's your equity and total equity. So we can look around 2001, 2002. Non-current liabilities, bank loan. Loan is the long term. And then we can look around. Okay, guys, just 1 second. You look, please look, the key headings. Okay, guys. So we need to look around the non-current asset, current liability, and then we have a total liability and total equities and liabilities. So what we need to total asset always equal to total. If you take out the total liability, this become equal to equity figures. Total asset minus total liability equal to total equity. Equity means the share are we call net asset. Net asset always equal to the equity figure. Accounting equation, couple of you already learned in other subject. Okay, so when we are saying conceptual framework, we need to be follow the qualitative characteristic of financial statement. Fundamental qualities of it need to be relevant. It's a capable of making difference. Decision include the materiality, which is mean, the financial statements should contain the relevant information. Faithful representation, the purpose to represent complete, neutral, and free from error. The information should be neutral, should be free from errors, and complete information. Okay, we can look around enhancing the qualitative characteristic, comparabilities, variabilities, timeline, and understandability. So these, the four characteristic are very important. Then we have an enhanced one as well. So we need 2 years, we need the information we can verify. Those have accounting knowledge, the figures, the present in a way and timely. It should be within, when finished within 30 to 90 days, it should be on the public domain. Okay, note of the financial statement provided where the notes of other financial reporting, standard additional information, accounting policies, which we follow. Financial statement must disclose, the accounting policies adopted by the director of the company. Then company should be selected, accounting policies which give true and fair financial performance position. Companies are not allowed to change, establish, accounting policy without the good reason. So we have a consistency. The depreciation and the so depreciation is the amount really is reduce the value of the asset. So basic rule recognize the depreciation charge for the each period in the profit and loss. Allocate depreciation amount, the asset and systematic basis like a straight line or whichever method you will use. Depreciation amount, cost, fair value minus residual values, which is mean end of the life of the asset, which asset we can sell it, and the residual amount is estimated amount would be obtained, disposal at the end of the life of the asset, which we can recover. We can follow ISA 16, which is property, plant, equipment, and depreciation of these, assets under IAS 16, and we can follow the method straight line diminishing or reducing balance method. So review the depreciation charge at each end of the year's minimum depreciation method, review the values, useful life of the asset. If change required, to treat a change of accounting estimates. For example, if the methods change, depreciate, using the new method our remaining useful life. If the useful life is changed, the depreciation carrying amount of the asset over the revised useful life, and disposal of derecognitions. Depreciation derecognize an item on disposal or when no future economics benefit are expected from the use of the disposal, gain and the loss of the disposal and derecognitions, and calculate the net the sale proceeds from carrying amount and where the based on the original cost and the fair value, and recognize the profit and loss. Okay, so next we are looking irrecoverable debt. Irrecoverable mean the money we can't recover it. It become known as assured, that's receivable will not be recovered. So we can write off these, the bad debts. Bad debts is mean you gave the loan to the customer. Customer don't have ability to uh, afford and return. So what we can do, we can look around irrecoverable debt debit and the sale ledger control account, because normally sale ledger mean is a trade receivable, or you can call them debtors, and so that's which will carry on. Doubtful debts, sometime the debit allowance for doubtful debts adjustments and credit the allowance for doubtful debts, and we carry on making the adjustments. Okay. Please always good to be in accounts. We do accounts on the accrual basis. Any income and expense related to the IE should be treated. So what we do accrual and prepayment treatment. So if it's accrual of expenses, we debit the expense. It's been expense incurred but not being paid. So like you use the gas electricity, but you not paid it. So we do debit the expense and credit the liability. Prepayment of expense. Prepayment mean is advance paid. So it's not an expense yet. So first place you did the debit the expense, credit the cash. Now you have to do the debit, credit the expense, you're reducing the expense, and you do debit the asset, because it's your still asset, it's not being consumed the money you paid advance. So we carry on making the adjustment in the book of account. If it's accrued income, so we do opposite than expense. Of course, accrual income mean you have received the money. Initially you did debit the cash, credit the income, but actually it's mean you receive advance. It's not, it's your liability. So what we need to do, increase your income by credit and increase your asset by debit. So that's which we'll carry on doing. Prepaid income. Prepaid mean you have received advance income. So you did the debit the cash, credit the income. Now this time you have to reduce the income, which is debit the income and credit the liability, because the prepaid is a liability for the business. So that's really you need to understand the concept. You all working in accounts, so that's why we hoping you already making adjustments. If someone not clear, please you can ask, and you can drop me email if you're listening in this recording. Okay, so what we can do, we can always good to be when you deal with the account, draw the timeline and look around, it will be prepaid for the period, because it's accrual basis, meaning income and expenses should be treated in those years accordingly. Okay, then we have a summary. So if you have expense accrued, type is liability. So expense debit and accrued credit, because accrued is the liability. So this is the summary of how we can make adjustment. Accrued income is asset, accrued income we do debit, and income we do credit. Prepaid mean advance, prepaid expense, debit, and the expense we do credit. Prepaid income is a liability, we do debit the income and credit the prepaid. Okay, guys, so what we need to do when you deal with these, make sure you make the adjustment, and sometimes errors happen in account, so you have to make the necessary. So different types of errors can be original entry errors. You make an original entry wrong, like such as you uh, debit the credit, but amount is incorrect. That can so we can reverse it and we can make the right entry. Reversal of entries you do, yes, sometime and when you do the reverse it mean actually you're crossing out, you have to do a gain entry to make adjustments. So principal errors, like maybe it's expense also goes debit, asset also goes debit. Maybe you debit the expense instead of asset, actually was asset, it should goes in the balance sheet instead of income statement. So that's these type of errors and adjustment, basic double entry bookkeeping concept should be, because under IS we need to be true and fair information. Commissions error of maybe you charging to the wrong person at the wrong heading at the wrong expense. So that's which we need to be making adjustment accordingly. Have the debit the entries and credit, so entries of duplicate sometime can be happen, so we need to be make sure remove the duplicate and make the necessary adjustment. Account balance is incorrectly can be transferred to the trial balance, so we can create even suspense account to balance. That's a temporary account, it won't go into and we can balance sheet. So these are all errors that can cause the difference to the debit and credit in the trial balance. Single entry maybe yes costing additional errors and transpositions errors, ex errors and omissions. Omission mean you miss something, and two entries one side that can be happening sometimes. So these, can imbalance your trial balance. And from the trial balance, if you pick bookkeeper, you preparing up to the trial balance, accountant from trial balance, they prepare the final. Okay, so errors not deducted. Sometimes it's difficult to deduct these errors, so we need to be make sure the error won't be happen, because you're doing the debit and credit correctly, your balance, your trial balance is the balance, but it's morally and ethically it's not true, because that goes in the balance sheet, you're putting in the income statement and so on, vice versa. So we need to be look around. Okay. Suspense account is also known as a temporary account, which will carry on and will carry on making it, and that's which we need to make adjustment to be reflect true and fair. Okay, then we have a 2.2 analyze the strength and the weaknesses of the financial report. The framework of the preparing and presenting the financial statement set out the concept underlying the financial statement external user. Sit the board of international accounting standard board, which help the new standard reviewing the existing standard is carry on and dealing with the topic not yet the cover under IAS IFRS, and they carry on in like we have IFRS 16 for leases is a new standard. The scope of the framework deal with the objective of the financial statement, qualitative characteristics that determine the usefulness of the information about the financial statement, definition, recognition, and measurement of the elements from which the financial statement constructed, not examined at this level. The concept of the capital and capital maintenance is not examinable at this. Underlying the exemptions and the framework, two underlying exemption, the accrual basis, which we always say is the account should be prepared accrual basis, mean the income and expense it should be treated in the year that's relevant, but it's not basis of the cash can become after maybe 5 years, 10 years, 2 years, whatever period. So faithful representation is always not absolute definition about fair presentation. We need true and fair according to the laws, according to at that time whatever in the best knowledge and estimation you have, you do qualitative characteristic which we discuss, comparability, these should be content. True and fair overrides IS state, the entity whose financial state and compliance should, yes, disclose, the facts. However, the international financial reporting compliance objective of the financial statement always we need to be look around the providing true and fair information. It's give the information about the financial performance and the people can make the decision. So interested parties, those use the financial statement, different, stakeholders like investors, existing lenders, implies stakeholders, they have a different interest, different purposes they use, and thus we need to be. And then we have 2.1 where we can look around financial ratios, compare and contrast the reporting the financial performance. So guys, financial ratios represent, performance of the company. So we can use different ratios like in other areas we discuss, which for following lessons we further discuss as well. Gross profit divided by sales, that's the profitability ratios. And this Anika and Papika's example we quoted and we've been given on our Moodle page as well. So we pick, our figures from statement of comprehensive income, income statement are we call profit and loss. So gross profit divided by sales are we call revenue. So we multiply 100. So we convert how many percent. So we can compare which company perform better. Operating profit, we look around and the difference between those, the gross profit and operating profit is your overhead expense. Gearing ratios, if you drive in the high gear, it's your gearing ratios come high, it will represent, the company is a high risk, so this company gearing ratio is 13.27, other is 71. So Papika is higher risky than Anika. Alternative, gearing two formulas will carry on using that divided by equity, and that mean long-term liabilities. So that's your we normally consider 4,000 divided by, and that's 15 and 20. So you will see the Papika is more risky than Anika. And then interest cover ratios we also known as profit from operation divided by finance cost, and how much interest, the profit is a higher than. So if it's a more higher, that's a less risky. Yeah? So this will carry on doing asset test ratios and all, and then the company performance maybe measured previous period, past result, maybe adjusted the prices, and we can comparison one period to other period. Horizontal try to be overcome the problem of vertical analysis is a common the company's performance for the period should be introduce a yardstick, the comparison. We can look around the similar company in the same industry, or don't compare like with the corner shop with the Tesco. So that's not a good comparison. It's the same size. Industry averages, which we can compare the performance. We can look around like, how much is the profit in hospitality, food, or various other industry. That's, which will carry on performance. Again, the financial ratios, the ratio maybe show the particular weakness of the company. It has the business plan, its weakness, turn into the around making changes. Maybe ratios will look good before COVID, but then COVID happened and you're looking the ratios, but you have to look around the current environment as well, its impact on your decision making like political, economic, social and technological factors. And the user of financial statement, investors, potential investor, lenders, suppliers and customer and government agencies, and they have a different interest, like government want to be take the tax, from the company. That's why they are interested in. Yes, so we compare Anika Papika, and then we can draw the report. Gross profit is the better, net profit, operating profit. So overall, we are saying Anika is a better than Papika, and we suggest, Anika company we can invest. Okay, so you've been given some task, please. Task 6.3 and 6.4 in a Osborne handout, chapter 6, which I'll show you as well. So that's, really we need to be follow. Anybody, any question, please? And that's all we're supposed to do. If you have any question, please, you can drop me email, ukversity.co.uk, and I'll try my best to get back to you as soon as possible. Please carry on looking these, recordings, also previous recording available on the Moodle as well. Please follow them. And make sure you will attend the next lesson, which will go through LO3. Thanks for attending and listening, and hope so speak you all during the next. Thank you. Bye bye.